And the life insurance industry has spent decades making term life insurance sound complicated. Here's the truth, it's not. It's the simplest product that exists. You pay a fixed monthly cost. If you die during the term, your family gets paid. That's it. No investment component, no hidden fees, no complexity. And for most working families, it's exactly what you need. By the end of this video, you're going to know three things: how term life insurance actually works and why it doesn't have the bells and whistles other products do, what you'll actually pay based on your age and health, and exactly how to figure out if you have enough coverage using two methods that don't require a calculator. So here's the deal. Term life insurance is a straightforward contract between you and an insurance company. You agree to pay a fixed premium every month or every year for a specific period. That's your term. Could be 10 years, 20 years, 30 years. The insurance company agrees to pay your beneficiaries a lump sum if you die during that term. No cash value builds up. You're not saving anything. You're buying one thing and one thing only, a death benefit. And because there's no investment component attached to it, the cost stays low. Let's talk actual numbers because that's what matters. A healthy 35-year-old woman can get $500,000 in coverage for 20 years for somewhere around 25 to $50 a month, depending on the carrier. A 35-year-old man paying $35 to $40 a month. Now, if you're 40, a woman, you're looking at roughly $30 to $40. A 40-year-old man, 50 to 70. These are real quotes. What moves the needle? Age, obviously. Health history, blood pressure, diabetes, anything on your medical record, tobacco use. If you smoke, you're paying double, sorry, sometimes triple. And here's the big one, time. A 35-year-old waiting until 45 to buy the same coverage pays double the monthly premium. Every year you wait, the math gets worse. So how much do you actually buy? There are two ways that work. The fast way, 10 times your annual income. Family makes $100,000 a year. You buy $1 million in coverage. Done. That gives your survivors 10 years of income replacement to adjust and rebuild. The more precise way is called the DIME method. D for debt, car loans, student loans, credit cards, whatever. I for income replacement. How many years does your family need your paycheck? If you've got young kids, maybe 20 years, your income times 20. M for mortgage, what you owe right now. And E for education, what college is going to cost. Add those four numbers together. That's what you need. Takes 10 minutes to do the math. The number one mistake I see all the time, people buy whole life insurance because someone tells them term insurance is temporary and they'll eventually have nothing to show for it. That's the wrong way to think about it. Term insurance isn't temporary. The protection lasts the full term you buy. And yes, when the term ends, you stop paying. But by then, you don't need it anymore because your kids are grown, your mortgage is paid down, and you've built actual wealth in your 401k or investments. Whole life is expensive because it bundles insurance with a savings component that has lousy returns and high fees. Buy term, build wealth separately. That's the strategy that actually works. If you're ready to figure out what you actually need and get a real quote, the link is in the description. Head to our agency site, answer a few health questions.